Welcome to the latest IFRS 15 Basics video. Step 3. Determine the transaction price. I'm sure you remember the IFRS 15 5-step model. In the previous videos, we have considered Step 1, identifying the contract with a customer, and Step 2, identifying the performance obligation in a contract. Today, we will cover Step 3, determine the transaction price. Once this step has been completed, the transaction price will be allocated to the performance obligation identified in the contract. This will be the foundation of revenue to be recognised. The transaction price reflects the amount of consideration that the company expects to be entitled to in exchange for goods or services transferred to the customer. The transaction price only includes the amounts the company has rights to under the present contract. It excludes amounts collected on behalf of third parties, as these amounts are not earned by the entity. Step 3 can be straightforward. For example, if a contract is for a fixed amount of cash, for a fixed number of goods, in a short period of time, then the transaction price would be the amount per the good. However, complexities can arise if a contract includes variable consideration, for example, price concessions or rebates, a significant financing component, non-cash consideration, or consideration payable to the customer that is other amounts paid to the customer, all of which need to be taken into account when assessing the transaction price. The transaction price is generally not adjusted to reflect the customer's credit risk, as credit risk is considered under IFRS 9 financial instruments. An exception exists where the arrangement contains a significant financing component. The financing component is determined using a discount rate that reflects the customer's creditworthiness. So, let's look at the impact of these different areas. Variable consideration is common and takes various forms, for example, price concessions, volume discounts, rebates, refunds, credits, incentives, performance bonuses, or royalties. There's a need to look further than just the contract terms. An entity's past business practices can identify variable consideration if there's a history of providing discounts or concessions after goods are sold to the customer. Consideration is also variable if the amount an entity will receive is contingent on a future event. This is true even if the contingent amount itself is fixed. For example, if a customer can return a product, it is unknown whether the item will be returned, but the refund will be a fixed amount. A fixed performance bonus could also be contingent on meeting certain goals. There is a need to estimate the amount of variable consideration by using either one of two methods, either expected value, which is the sum of the probability-weighted amounts in a range of possible consideration amounts. The other is the most likely amount, which is the single most likely outcome. This is not a policy choice. The company should use the method that it expects to better predict the amount of consideration to which the company will be entitled, based on the terms of the contract. An expected value may be an appropriate estimate if the company has a large number of contracts with similar characteristics. Alternatively, the most likely amount may be an appropriate estimate if the contract has only two possible outcomes. For example, a company either achieves a performance bonus or it does not. Management should consider and quantify all possible outcomes when using the expected method. However, this could be costly and complex. A limited number of discrete outcomes and probabilities can provide a reasonable estimate of the distribution of possible outcomes in many cases. IFRS 15 includes a constraint over the amount of variable consideration included in the transaction price. The standard explains that this is to provide more useful information to the users of the financial statements. The transaction price should include some or all of the variable consideration, only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognised will not occur, when the uncertainty is subsequently resolved. If the potential reversal is not significant, variable consideration would not be constrained. The transaction price would consider both variable consideration in an arrangement and any fixed consideration to assess the significance of a reversal. This is because the constraint applies to the cumulative revenue recognised, not just to the variable portion. It is worth noting that the constraint could apply to a portion of the estimate of variable consideration. That is, the company needs to include a minimum amount of variable consideration in the transaction price, and this will be the case even if other portions of the variable consideration are constrained. To facilitate the assessment of the constraint over variable consideration, IFRS 15 provides factors to consider. Factors that could increase the likelihood or magnitude of a revenue reversal include, but not limited to, any of the following. The amount of consideration is highly susceptible to factors outside the entity's influence. The factors may include volatility in a market, the judgment or actions of third parties, weather conditions, and a high risk of obsolescence of a promised good or service. The uncertainty about the amount of consideration is not expected to be resolved for a long period of time. The entity's experience or other evidence with similar types of contracts is limited, or that experience or other evidence has limited predictive value. The entity has a practice of either offering a broad range of price concessions or changing the payment terms and conditions of similar contracts in similar circumstances. The contract has a large number and broad range of possible consideration amounts. All of the factors should be considered, and no single factor is determinative. Another area to consider is whether there is a significant financing component. IFRS 15 provides guidance on accounting for arrangements with a significant financing component. Contracts contain a financing component either explicitly or implicitly. This will happen because payments by a customer occurs either significantly before or significantly after performance under the contract. This timing difference can benefit either the customer or the entity. If a significant financing component exists, the company should adjust the promised amount of consideration in the transaction price for the impact of the time value of money. The objective is to recognise revenue at an amount that reflects the cash selling price of the goods or services to be provided to the customer. Interest income or interest expense resulting from a significant financing component should be presented separately from revenue, as this does not fall into the definition of revenue under IFRS 15. The discount rate to be used when adjusting the promised amount of consideration for the time value should reflect the rate that would be used in a separate financing transaction between the entity and its customer. This rate should reflect the credit risk of the party obtaining financing in the arrangement. In the standard, there is a practical expedient. This means that companies can disregard the effects of a financing component if it is expected at contract inception that the period between transfer of a promised good or service to the customer and when the customer pays for that good or service will be 1 year or less. So when a company assesses if there is a significant financing component, it should consider the difference between the amount of promised consideration and the cash selling price of the promised goods or services, and the combined effect of the expected length between transfers of goods or services and the customer's payment for those goods or services and the prevailing interest rates in the relevant market. In a similar way to variable consideration, IFRS 15 also provides factors that indicate a significant financing component does not exist. There is not a significant financing component if any of the following factors exist. The customer paid for the goods or services in advance, and the timing of the transfer of those goods or services is at the discretion of the customer. A substantial amount of the consideration promised by the customer is variable, and the amount or timing of that consideration varies on the basis of the occurrence or non-occurrence of a future event that is not substantially within control of the customer or the entity. An example would be if the consideration is a sales-based royalty. The difference between the promised consideration and the cash selling price of the good or service arises for reasons other than the provision of financing to either the customer or the entity, and the difference between those amounts is proportional to the reason for the difference. For example, the payment terms might provide the entity or the customer with protection from the other party failing to adequately complete some or all of its obligations under the contract. Any non-cash consideration received by the entity from a customer, for example stocks or materials, needs to be reflected in the transaction price. Non-cash consideration is measured at fair value. In some cases, management is not able to reliably determine the fair value. If so, the value should be measured indirectly by reference to the standalone selling price of the goods or services provided by the entity. Non-cash consideration may be provided to facilitate contract fulfillment. For example, materials to be used in the development of a machine may be provided by the customer. The fair value of the material should be reflected in the transaction price if the company obtains control of the materials. Another impact on the transaction price is when a company may pay or expect to pay consideration to its customer. This can be cash, either in the form of rebates or upfront payments, or it could be a credit or some other form of an incentive. A company should reduce the transaction price for such consideration payable to a customer, unless the payment is in exchange for a distinct good or service that the customer transfers to the entity. This would mean there would be a separate arrangement for the goods or services being delivered by the customer. So determining the transaction price is not always as easy as it looks. Complexities can arise if the contract includes, for example, variable consideration. However, using the guidance we have discussed should help you to satisfy step 3 of the 5-step approach. I hope that this video has been helpful. Look out for step 4 coming shortly.